Listen to me carefully right now as you are watching this. Somewhere inside the global, a trader just lost the entirety. Not due to the fact they were silly, not due to the fact they didn't work difficult, but due to the fact they dedicated the only sin that the marketplace in no way forgives. They entered at the incorrect time. I've seen it happen 1,000 instances. I've watched fortunes evaporate in hours due to the fact someone thought they may outsmart the tape. They could not, and neither can you. Unless you recognize what I'm about to inform you. The marketplace would not care approximately your analysis. It does not care about your signs. It doesn't care approximately the money you need to pay your bills. The simplest component that matters is timing. Master it or maintain bleeding cash till there may be nothing left. I'm going to show you exactly how the specialists time their entries and why the whole thing you have been taught might be placing you up for disaster. You want to know the real reason most investors fail. It's now not lack of understanding. It's now not even loss of area, though it really is a part of it. The real reason is that they are playing a recreation they don't understand with rules no one ever defined to them. They're taught to buy low and sell high as though the market has a sign that asserts that is low and this is high. They're advised to comply with traits, however no one tells them a way to become aware of whilst a trend is about to reverse and lure them. They study aid and resistance, then watch in horror as those tiers get smashed via like they had been made of paper. I need to realize, I've made thousands and thousands and lost hundreds of thousands. And the difference between the two usually came all the way down to one issue, timing. When I changed into young, I turned into clever. I'd watch a stock flow up and I'd think, time to quick it? Or I'd see inventory falling and assume it's gotten too cheap. Time to buy. You realize what passed off. I were given destroyed time and again, due to the fact I become fighting the marketplace in preference to studying it. The market was telling me exactly what it become going to do, but I was too arrogant to concentrate. I changed into implementing my opinion on charge motion, as opposed to letting rate action manual my decisions. That's what kills buyers. Their ego, their want to be right, their stubborn perception that they recognize better than the collective information of hundreds of thousands of individuals putting real cash on the line. Here's what changed the entirety for me. I stopped trying to expect, in which the market need to pass and commenced watching wherein it was sincerely going. I stopped fighting obvious movements because they regarded too prolonged and started writing them. I learned that the marketplace can live irrational longer than you may stay solvent and that trying to pick tops and bottoms is a fool's game. The money isn't made with the aid of being contrarian for the sake of it. The money is made by way of recognizing when the market is in movement and positioning yourself in alignment with that motion at precisely the right second. Not too early, now not too past due, however, at that precise point in which probability shifts dramatically on your prefer. Think about it like this. Every foremost pass within the market goes through awesome stages. First, there may be accumulation or distribution where the smart money is quietly positioning itself whilst maximum, human beings are not paying attention. Then there is the markup or markdown section wherein rate starts off evolved to move in a clean route. This is followed with the aid of the public participation section in which all and sundry notices the flow and jumps in. Finally, there may be the climactic section where the flow exhausts itself and reverses. Now, in which do most investors input? They input during the public participation segment or worse, all through the climactic section, proper earlier than the reversal. They're shopping for tops and selling bottoms because they're reacting to what is already obvious in preference to positioning themselves ahead of the apparent. The specialists do the contrary. They're accumulating when no person's looking. They're building positions at some point of those uninteresting sideways, markets that put everybody else to sleep. They're coming into when the technical setup is perfect, however before the circulate has attracted interest. Then, while every person else is piling in past due, they're already sitting on enormous income and preparing to go out. This isn't insider trading. This isn't always manipulation. This is in reality, know-how marketplace psychology and timing your entries to align with in which institutional money is flowing as a substitute than where retail investors are dashing. Let me inform you about a dollar trade that taught me this lesson inside the maximum, painful way possible. It become cotton. I'd carried out my studies and I become convinced. Cotton changed into going better. I became right about the course. Dead proper, but I've become incorrect about the timing. And in trading, being proper at the incorrect time is similar to being wrong. I entered too early. The marketplace wasn't equipped to move, but for weeks, my roll simply sat there bleeding me through small losses and possibility value. I watched different opportunities pass by way of because my capital become tied up in a roll that changed into going nowhere. Finally, I could not take it anymore and closed the location for a loss. And you recognize what occurred subsequent. Cotton exploded higher. Exactly as I'd expected. The circulate was there. The possibility was actual, however my timing was off, and that made all of the distinction among a big win and a frustrating loss. That revelin taught me something crucial. The marketplace would not praise you for being right in theory. It only rewards you for being right in practice on the right time. With the right roll size, you can have the first class evaluation in the global. But if you input earlier than the market is ready to transport, you may either get stopped out for a loss or watch your capital sit down while higher opportunities pass you through. Timing is not simply crucial, it is the whole lot. It's the distinction between steady earnings and steady frustration. It's the difference between growing your account and looking at it slowly bleed away via dying through 1,000 cuts. So how do you broaden this timing? How do you learn to input on the factor of maximum opportunity and minimal danger? It starts with knowledge that price action tells you the whole thing you want to recognize. Not your signs, not your oscillators, no longer your complex algorithms. Price pure easy fee motion. When I have a look at a chart, I'm no longer looking at what I think ought to manifest. I'm searching at what is going on proper now. I'm observing how rate is behaving at key tiers. Is it respecting aid and resistance, or is it slicing through them? Is extent confirming the flow, or is fee shifting on skinny air? Are we seeing climactic volume that shows exhaustion or steady accumulation that shows clever cash positioning? The satisfactory entry points share commonplace characteristics. They occur at moments of transition while the market shifts from one state to every other. Think about it. When does a stock this has been in a downtrend sooner or later bottom? It does not just switch on a dime out of nowhere. First, you spot the downward momentum begin to sluggish, the selling waves grow to be less severe. Then you see a test of the lows in which price holds developing a double backside or some other reversal sample. Volume regularly spikes on this. Take a look at as sellers exhaust themselves. Then, and best then, do you spot the primary symptoms of buying pressure? Price starts off evolved to preserve above quick time period shifting averages. It begins to make better lows. The individual of the marketplace adjustments from dealers in control to consumers stepping in. That transition factor, that shift in person, that's where the professional enters. Not at the lowest, now not after the circulate is apparent, however right at that inflection point where chance shifts. The equal principle applies to breakouts. Most investors chase breakouts when they've already came about. They see a stock breaking above resistance with a large inexperienced candle, and they soar in eager to capture the pass. You understand what takes place subsequent. The stock reverses and they are caught in a bull lure. Why? Because they entered after the move, no longer before it. The accurate way to play breakouts is to roll yourself earlier than the breakout takes place. When price is consolidating just underneath resistance, constructing electricity like a coiled spring, you look ahead to volume to dry up, indicating that sellers are exhausted. You watch for price to hold better and higher lows inside the consolidation, indicating accumulation. Then while you see the one's first symptoms of purchasing stress starting to make bigger, it is whilst you enter before the breakout, no longer after it. Your hazard is absolutely described. If fee breaks returned into the consolidation, you're wrong and also you exit. But if you're proper, you catch the complete circulate from the beginning. Now not just the exhausted quit of it. This is what separates specialists from amateurs. Amateurs react to what's already passed off. Professionals expect what is about to happen based on how fee is setting up. Amateurs chase momentum after it's apparent. Professionals position themselves in advance of momentum, then allow the crowd chase the pass and offer their go-out liquidity. Amateurs input based on desire and excitement. Professionals input based on calculated possibility and clear threat control. The difference in effects is astonishing. One organization slowly loses money via poor entries and awful timing. The different group always profits through coming into it factors where rain danger is minimum and capacity praises full size. Now, I recognize what you are questioning. This all sounds superb in principle. However, how do you honestly become aware of those perfect entry points in actual time? How do you understand while the market is actually moving as opposed to while it is only a fake flow with a view to opposite and lure you? That's the million-dollar question, isn't always it? And the answer is experience combined with systematic remark. You want to expand a feel for marketplace rhythm, for the EB and float of charge motion. You want to observe thousands of setups shape and play out so your thoughts begins to recognize the styles intuitively. But more than that, you want a framework, a systematic manner of evaluating whether a setup meets your criteria or now not. Here's mine, and also you can adapt it to your very own style. First, I never input a trade unless the wider marketplace context supports the pass. If I'm searching at a protracted setup, I want to peer the general marketplace in a bullish segment, no longer combating against a bearish tide. Going towards the market fashion can paintings, but it dramatically reduces your probability of achievement. So, why fight with one hand tied in the back of your again? Second, I need to peer clean evidence of accumulation or distribution at key ranges. This indicates up and volume styles in how rate behaves at assist or resistance inside the individual of the candlesticks or bars. Third, I need a clear catalyst or technical cause on the way to in all likelihood entice other customers or dealers. This could be a breakout above a key degree, a success check of help, a moving average go, or any range of technical triggers that have a tendency to attract attention and create momentum. Fourth, I want clean chance definition. I want to know precisely where I'm wrong, and that level desires to be near sufficient that my danger is appropriate relative to my ability praise. If I can't outline a clean prevent loss stage that makes sense, I do not take the alternate period. When all four of those factors align, that is after I strike, not before. I don't take trades due to the fact I'm bored, or due to the fact I sense like I ought to be doing something. I wait patiently for these excessive chance setups where all the elements line up in my favor. This method I'm now not constantly inside the market. In truth, I'm out of the market greater than I'm in it. I'm looking at, awaiting that ideal pitch. And whilst it comes, I swing tough. This is the way you compound wealth within the markets. Not with the aid of buying and selling constantly, no longer by staying busy, but via watching for those moments where the odds are stacked closely on your choose, then committing capital with conviction. Most investors do the opposite. They take marginal setups continuously due to the fact they can't stand being on the sidelines. Then they surprise why their consequences are mediocre at satisfactory. Let me provide you with a cutting-edge instance that illustrates those principles flawlessly. Think approximately how the big tech stocks flow at some point of the various bull and naked markets of the beyond decade. Time and time once more you'd see the equal pattern play out. A. Inventory could go through a correction, pulling back to a key shifting common or support stage. The monetary media could run poor stories. Retail buyers might panic and promote. Then you'll see the stocks start to hold at that help degree. Volume would spike on down days, but charge wouldn't ruin decrease. Then, unexpectedly, you'd see a reversal day with strong extent and fee last close to the highs. That changed into your sign. That became the marketplace telling you that institutional buyers have been stepping in, absorbing the selling and making ready to mark costs higher. The buyers who entered at that point, while it changed into nonetheless uncomfortable and uncertain, made fortunes. The traders who waited for affirmation, who desired to peer several days of robust upside earlier than they believed the circulate changed into actual, entered late and often were given caught within the first pullback. This equal pattern repeats across all time frames in all markets during history. Human psychology does not trade. Fear and greed don't exchange. The patterns that paintings nowadays are the identical patterns that worked when I turned into trading 100 years ago. And there'll be the identical styles that work 100 years from now. The precise signs would possibly trade. The technology might evolve. However, the underlying dynamics of the way markets pass from equilibrium to momentum and back to equilibrium, those are everlasting. Master those dynamics. Master the timing of entries and exits within those dynamics, and you have a skill a good way to serve you for existence. But right here's in which most buyers go wrong. Even once they apprehend these concepts intellectually, they realize they ought to watch for excessive probability setups. They recognize they must enter at inflection factors in preference to chasing moves. But in the warmth of the moment, while they're watching a stock rocket higher without them, they abandon their discipline. They cannot stand the pain of lacking out. So they chase. They input at exactly the incorrect time, pushed by way of emotion rather than good judgment. Then when the inevitable pullback occurs, they panic and sell, locking in a loss. This cycle repeats again and again, and they in no way wreck unfastened because they in no way broaden the emotional manipulate important to pace to their plan. Trading success isn't approximately having greater knowledge than the next person. By now, the fundamentals of technical analysis are to be had to anyone with a web connection. The information isn't mystery. The styles aren't hidden. What separates winners from losers is emotional field. The ability to comply with your guidelines even when each fiber of your being desires to break them. The capacity to sit down in your palms while there's no right setup even though you're bored and keen to trade. The capability to take your profits when your plan says to go out, even although the function might cross further to your prefer. The capability to reduce your losses quick whilst you're incorrect, even though admitting defeat is psychologically painful. These are the competencies that be counted. These are the abilities that determine whether or not you live to tell the tale and thrive or blow up your account and stop. And right here's the component no one tells you. Developing those abilities takes time. It takes screen time, watching markets on a daily basis, month after month, until the styles grow to be second nature. It takes actual money on the line because paper trading does not create the emotional pressure that, well, known shows your mental weaknesses. It takes losses, painful losses that train you what now not to do. Every successful trader has blown up as a minimum one account. Every successful trader has made each mistake inside the ebook. The difference is that they study from the one's errors as opposed to repeating them ad infinitum. They advance the intellectual database of what works and what would not via painful experience. And they use that expertise to refine their method till it became continuously worthwhile. So when I tell you that timing is the whole thing, I'm no longer simply speaking about the mechanical factor of identifying access points. I'm speaking approximately the complete bundle. The marketplace awareness, the sample reputation, the emotional subject, the chance control, the persistence to attend, and the courage to act whilst the moment arrives. All of those factors paintings collectively to create what looks as if ideal timing from the out of doors. But it is no longer success. It's not some innate present. It's a ability advanced through committed practice and painful lessons. And it's available to each person willing to position inside the work and pay the lessons the market demands. The query you need to ask yourself is this: are you willing to do what it takes? Are you willing to study charts for hours, not simply looking for setups, but without a doubt observing how rate behaves in exceptional conditions? Are you willing to keep a detailed buying and selling magazine, recording every change, every emotion, every deviation out of your plan, so that you can discover your styles and accurate them? Are you willing to chance real cash, understanding you'll lose a number of it in the method of mastering, however viewing the one's losses as lessons instead of failures? Are you willing to sit on your hands for days or perhaps weeks awaiting the proper setup, even though it's uninteresting and also you experience such as you must be doing something? If you could solution yes to these questions, if you may decide to this route, then you definitely have a chance. If now not, store yourself the pain and discover something else to do along with your time and money. I've given you the foundation. I've explained how market timing honestly works, why it's essential, and what separates precise timing from bad. But knowledge these standards intellectually is just the start. Now comes the tough component. Now comes the implementation, the exercise, the grinding work of developing this ability through repeated exposure to real market conditions. There are not any shortcuts. There are no magic indicators with a purpose to do this for you. There's just you, the marketplace, and the alternatives you are making inside the moment. Choose wisely. Choose based totally on chance as opposed to emotion, and you will provide yourself a preventing danger. Choose poorly. Let your feelings pressure your selections, and you may be a part of the sizable majority of investors who in no way make it beyond their first year. The market is ready. It doesn't care whether or not you succeed or fail. It will present opportunities to those who are organized to peer them and capture them at the proper moment. It will punish people who enter at the wrong times, who chase movements out, of worry of missing out, who let wish and denial hold them in dropping positions too lengthy. The desire is yours. But make no mistake, if you do not grasp timing, you'll preserve losing money. That's now not a risk. It's an easy statement of reality, confirmed over and over at some point of market history. The query isn't always whether timing matters. The question is whether or not you're willing to do what it takes to grasp it. And that solution will determine the entirety about your destiny as a dealer. Now, permit me take you deeper into the mechanics of timing. Because know how the concept is one component, however executing it always is any other beast totally. You see, most investors method timing like it's a binary decision. Either you are in or you're out. But that's no longer how specialists think about it. We assume in phrases of zones of building positions regularly as evidence accumulates that we are, right? And decreasing positions regularly as evidence accumulates that the setup is failing. This idea of scaling is essential to right timing. Yet, it's nearly never mentioned in trading training material because it would not, healthy neatly into the simplistic purchase here, sell their narrative that novices want to listen. Think about how institutional buyers perform. They're no longer placing their whole position on in a single shot at one price stage. They can't. Their length is just too massive. If they tried to buy 10 million shares on the marketplace that they had flow the rate towards themselves before, they crammed one body to the order. So what do? They collect steadily. They construct a roll over hours, days, or even weeks shopping for dips, soaking up deliver, never displaying their complete hand to the market. Then when they're completely placed and ready for the markup phase, they step aside and permit momentum. Buyers chase the move higher, offering liquidity for their eventual go out. This is the sport inside the game. And in case you do not understand it, you're playing checkers even as everyone else is playing chess. As a retail trader, you have got advantages that institutions don't have. You can flow inside and outside of positions instantly. You can change your mind and be completely flat inside seconds. You don't have to fear approximately transferring the marketplace with your orders. But maximum retail, buyers squander these blessings through appearing like day buyers on cocaine, leaping inside and outside of positions on a whim, never giving appropriate setups time to broaden, by no means constructing positions strategically. They deal with buying and selling like a video game where the purpose is to make as many trades as feasible, whilst in reality, the goal is to make as a good deal cash as feasible, which generally means making fewer better trades. Here's how I suppose approximately scaling into positions. When I pick out a high probability setup that meets all my criteria, I do not immediately place my full function size on. I begin with a pilot function, perhaps 1p3 to half of my intended complete length. This is my take a look at. I'm dipping my toe in the water to see how charge responds. If I'm right and rate right away begins shifting in my desire, I'll add to the location on the first pullback, increasing my size as my confidence grows and my length preliminary entry will become worthwhile, giving me a cushion. If I'm incorrect and charge is going in opposition to me, I'm best risking a fragment of what I might have risked if I'd long passed Allen straight away. This method does crucial matters. It reduces my danger on trades that don't work out, and it improves my common access rate on trades that do work out. Over hundreds of trades, this single technique may be the distinction among marginal profitability and vast returns. The secret to making this paintings is having in reality described tiers in which you'll add on your function and genuinely defined degrees in which you'll abandon the setup entirely. You cannot just wing it. You need a plan earlier than you input, and you want the area to follow that plan no matter the way you sense inside the moment. Let's say you're looking at a breakout setup. Your initial entry is probably on the first test of the breakout stage with strong extent at the same time as charge remains within the consolidation. Your advert factor is probably on a hit retest of the breakout degree as new support. Your prevent losses below the consolidation, meaning if charge breaks back into the range, you're wrong, and also you go out the whole function. Your income target might be the measured circulate from the consolidation or a key resistance level above. Having this plan written down, before you enter approach, you don't have to make emotional choices in real time. You simply execute the plan robotically. This brings up every other crucial issue of timing that nobody talks approximately the timing of your exits. Everyone obsesses over entries because it truly is the interesting part, but the truth is that your exit determines your income or loss. Now, not your access. You can input at a mediocre fee and nevertheless make cash if you exit well. You can enter at a really perfect fee and nevertheless lose money if you go out poorly. Yet, most traders spend 90% in their time considering entries and 10% thinking about exits when it have to be in the direction of 50 to re-50 or even weighted towards exits. There are three sorts of exits you want to devise for before you input any exchange. First, your stop-loss exit, in which you're wrong and need to cut the position to save you further harm. Second, your income goal exit, where you've got achieved your objective and it makes experience to take the cash and circulate on. Third, your trailing forestall go out, where the trade is running beyond your initial expectations and also you need to allow income, run while protective profits. Most investors simplest consider the first one, and even then they often pass their stops or remove them entirely when fee processes, turning what must be small losses into failures. Your prevent loss placement is sincerely a timing selection. Now, not just a risk management selection. Where you location your stop tells you something vital about your access timing. If you have to region your prevent very far out of your access to keep away from normal market noise, that is a crimson flag that you are getting into at a suboptimal time. The nice entries permit for tight stops due to the fact you're coming into an inflection point wherein price should immediately start transferring on your favor. If you're proper, in case you need a huge forestall, you're possibly entering within the center of a circulate in preference to at the start of one. And it is a timing error. I learned this lesson the tough manner. Looking small losses grow to be huge losses because I entered at wrong instances with huge stops hoping the marketplace would, in the end, come back my manner. Hope is not a strategy. Tight stops at logical tiers are a signal that your timing is ideal. Profit goals are trickier due to the fact you never recognize how a long way a pass will cross. A move that looks prolonged and geared up to reverse can hold going for days or even weeks. A flow that looks like it is simply getting commenced can stall and reverse without warning. This is in which maximum traders torture themselves. Exiting too early and watching profits evaporate, or protecting too long and looking profits become losses. The solution is to have a systematic technique. I usually take partial earnings at my preliminary target, maybe 1.2 my position, then path a forestall and the rest to permit it run if the pass maintains. This manner I'm guaranteed to seize a few profit if I'm right. However, I'm additionally located to capture remarkable earnings if I'm virtually right. It's a compromise, however, it's a compromise that works over many trades. The trailing stop is your buddy, in case you use it efficiently. It allows you to stay in winning trades even as protective accumulated income. But you can't path too tightly or you'll get shaken out on everyday volatility. You cannot trail too loosely or you may return too much whilst the exchange sooner or later reverses. I normally trail based totally on marketplace structure, helping my prevent to underneath current swing lows on an uptrend or under important shifting averages that have been respected for the duration of the pass. The actual method matters much less than having a way and following it continuously. What kills traders is not the method itself. It's the abandoning of the technique whilst feelings take over. Let me inform you about the concept of marketplace rhythm, because this is fundamental to timing, and it's something you may simplest research via Revel in. Every marketplace has a rhythm, a characteristic way it movements primarily based at the contributors concerned and the time frame you're trading. The inventory marketplace has a distinctive rhythm than the commodity markets. Individual stocks have distinct rhythms based totally on their liquidity and volatility. Even the identical inventory could have different rhythms in one of a kind market situations. A tight, uneven rhythm for the duration of consolidations and an easy trending rhythm at some point of strong movements. Learning to experience this rhythm is crucial to good timing. When you are in sync with the market's rhythm, trading feels clean. Your entries paintings, your exits make sense. You can feel when to be aggressive and when to be protective. When you are out of sync with the market's rhythm, the whole lot is tough. You're continuously getting stopped out. Your entries right away move in opposition to you. Your exits are either too early or too past due. This is mostly a signal that marketplace conditions have modified and your method wishes to modify. Maybe the marketplace has shifted from trending to uneven or from low volatility to excessive volatility, and the techniques that labored final week do not paintings this week. Recognizing those shifts quick and adjusting your approach is every other form of timing that separates experts from amateurs. One of the most important rhythm shifts to recognize is the transition from a choppy range-bound market to a trending market. In uneven markets, the nice technique is to vanish extremes, sell near the pinnacle of the variety, buy near the bottom of the variety, take short income. But in case you maintain this approach when the market breaks into a trend, you will get destroyed. You'll be shorting the top of the variety just as it breaks higher or shopping for the bottom of the variety simply as it breaks decrease. You want to apprehend the breakout quickly. Admit you're on the wrong aspect. Flip your roll and journey the trend till it shows signs of exhaustion. This takes mental flexibility that most investors don't have. They get locked into one view of the marketplace and cannot modify while conditions trade. The opposite transition is equally crucial, recognizing when a trending market is shifting right into a choppy range-bound market. This is where fashion fans get killed. They've been making money driving the trend, so they preserve attempting to shop for dips or promote rallies, looking forward to the trend to maintain. But now those dips and rallies are simply actions inside a range, and they're getting into it exactly the incorrect instances, shopping for the top of the range and promoting the bottom of the range. They deliver back all their earnings and greater because they cannot apprehend that the sport has changed. The secret's to observe while the character of the charge action modifications, while momentum begins to wane, while breakouts start to fail, when the marketplace stops making development inside the direction of the fashion. These are signs and symptoms that it is time to shift strategies or step apart completely. Stepping apart is itself a timing choice, and it's one that most traders never make consciously. They feel like they must continually be in a roll, constantly have something running due to the fact otherwise they may be now not definitely buying and selling. This is an essential misunderstanding of what expert buying and selling is set. Professional buying and selling is set deploying capital whilst conditions are favorable and sitting to your palms while they may be no longer. It's approximately spotting that there are instances whilst the marketplace is supplying high chance possibilities and instances whilst it's not, and adjusting your hobby level hence. The satisfactory buyers I've recognized spent the bulk of their time ready, now not trading. They had been affected person predators holding power, looking for that best moment to strike. When it got here, they dedicated fully. Then they went lower back to waiting. This patience is unnatural for most human beings. We're stressed out to need steady motion, regular stimulation, constant progress. The market exploits this tendency mercilessly. It rewards patience and punishes impulsiveness. It rewards those who can sit through boredom and uncertainty anticipating their pitch. It punishes folks who need steady movement and change just to feel like they're doing something. If you can increase this endurance, you want to find a special manner to make money, because trading will systematically extract wealth from you via 1,000 small impulsive selections that appear insignificant in the moment, however upload, as much as full-size losses over time. Here's some other timing principle that took me years to study. The great time to trade is when you don't need to trade. When you're desperate. When you want to make money to pay payments or recover losses, your timing could be horrible. You'll force trades that are not there. You'll maintain losers too lengthy, hoping they may come lower back. You'll exit winners too early due to the fact you need to lock in income. You're trading from a position of weak spot, and the marketplace can sense weak point. Conversely, while you're affected person when you have capital available, however, sense no stress to deploy it, your timing improves dramatically. You can look forward to the ideal setup. You can permit income run. You can reduce losses quick without emotional attachment. You're trading from a position of energy, and that energy interprets into higher decisions and higher results. This is why proper position sizing is definitely a timing device. If your positions are too big relative for your capital, every everyday marketplace wiggle becomes emotionally charged. You can't think simply, you cannot execute your plan. Your timing falls aside because you're too scared or too excited. But in case your positions are accurately sized, where a stop loss is disappointing but not devastating, you could continue to be objective. You can execute your plan. Your timing improves because you're not trading from emotion. Most investors blow up no longer due to the fact their analysis changed into incorrect, but due to the fact their function size turned into too big, causing them to make emotional timing mistakes they, by no means, could have made with well-sized positions. Let me percentage with you one of the maximum precious timing strategies I've ever learned. And it's so easy that maximum traders disregard it. Before you enter any trade, ask yourself, can I manage to pay for to be incorrect? Not financially. We've already protected function sizing. I imply mentally and emotionally. If this trade is going against you, will you be capable of cut the loss cleanly and pass on? Or will you be so connected to being right that you will preserve and hope, and sooner or later turn a small loss right into a catastrophe? If you cannot in reality say that you'll take the loss without drama, do not input the exchange. Your timing is already compromised by way of your emotional country. Wait for a setup that you could approach objectively where you honestly do not care whether or not it really works or not due to the fact you've got 10 more setups ready. That detachment, that emotional neutrality, that is when your timing is at its high quality. This principle extends to scaling out of positions as properly. Most traders war with taking earnings because they're terrified of being incorrect, scared of exiting too early, and missing out on additional earnings gains. This worry compromises their go-out timing. They maintain positions too lengthy, watching earnings cut back or disappear entirely because they cannot pull the solution is to get rid of the emotional weight by way of taking partial profits. Once you've locked in some advantage, you have already gained. Now you may permit the rest run with a clean mind, or you could go out to the rest at any factor without remorse. This approach of taking partials transforms your psychology around exits, which immediately improves your timing. The cumulative effect of some of these timing decisions, your access, your roll sizing, your advertisements, your partial exits, your trailing stops, your very last exits determines your typical buying and selling results. Two investors could have the precise identical setups, the exact same marketplace examined. However, absolutely specific results based totally in simple terms at the timing of their execution. One enters too early and gets shaken out earlier than the flow starts off evolve. The other enters at the most appropriate point and rides the whole circulate. One sizes too huge and exits from fear. The other sizes as it should be and executes the plan flawlessly. These timing variations compound over hundreds of trades to create massive divergences in effects. This is why you cannot simply replica someone else's trades and expect to get their outcomes. The timing of each decision matters, and that timing comes out of your very own psychology, your own enjoy, your personal discipline. So whilst a person asks me what the name of the game to trading success is, I do not speak approximately signs or strategies or market theories. I communicate approximately timing. I speak about growing the ability to understand whilst chances to your prefer and the area to behave on that reputation. I speak about the staying power to anticipate those moments and the braveness to commit when they come. I speak approximately the mental flexibility to modify while conditions alternate and the emotional manage to execute your plan regardless of worry or greed. These are timing abilities, all of them, and they are far greater essential than any technical pattern or indicator you could ever examine. Master these and you will make cash in any marketplace with any approach. Fail to grasp these and it doesn't count what strategy you operate. You'll preserve losing money until you either stop or subsequently research what I'm teaching you proper now. Now, I want to address something this has in all likelihood been nagging at you this complete time. You're questioning, this all sounds super, however, how do I genuinely practice those timing competencies? How do I expand this instinct without blowing up my account inside the method? That's a valid question, and it is one which merits a considerate answer, because the learning curve in SaaS trading is brutal and highly priced if you method it incorrect. Most investors deal with their live account like a video game, taking random trades, getting to know not anything from their losses, and sooner or later quitting whilst their cash runs out. There's a better manner, however it requires shape and discipline. 2. Features maximum buyers lack. First, you need first of all observation, not participation. Before you hazard unmarried greenback, you want to spend time watching markets, recording potential setups, and monitoring how they play out. I'm no longer talking approximately paper buying and selling, where you pretend to take trades and pat yourself at the again for pretended income. I'm speaking approximately genuine market commentary, where you identify setups, word what makes them attractive, expect how they may play out, after which watch without any emotional stake inside the outcome. Do this for several months, and you may begin to construct an intellectual database of what works and what would not. You'll see styles emerge. You'll note that certain setups paintings in positive situations and fail in others. You'll increase a sense for marketplace rhythm without risking any capital. This is the basis. Once you've finished this foundation, and you've a clear facet that you've documented through statement, then and only then need you start buying and selling with real money. But start small, ridiculously small. Small sufficient that a loss would not bother you emotionally at all. Why? Because you're not seeking to make money at this degree. You're trying to execute your plan flawlessly whilst cash is on the line. You're seeking to find out the psychological variations among watching a change and being an alternate. You're trying to identify the emotional patterns that reason you to deviate out of your plan. If you begin with massive positions, you may be too emotional to research whatever. You'll just repeat the equal mistakes over and over because you are in survival mode instead of gaining knowledge of mode. Keep a detailed magazine of every trade. Not simply the entry and exit charges, but your notion process. What made your taking the exchange? What became your plan? How did you feel throughout the trade? Where did you deviate out of your plan, if at all? What might you do in another way? This journal is extra precious than any buying and selling ebook you could read, as it's a document of your personal psychology, your personal styles, your personal edge taking shape. Review it weekly. Look for patterns to your behavior. Are you continually exiting winners too early? Are you holding losers too long? Are you entering earlier than your setup is complete because you are impatient? These styles will monitor themselves if you're honest in your journaling. And when you see them, certainly, you can work on correcting them. The toughest part of this manner is being honest with yourself. It's so tempting to rationalize horrific trades, to make excuses, guilty the marketplace or awful success or some external element. But the market doesn't care approximately your excuses. Either you're getting cash or you are dropping cash. And in case you're dropping money, something in your method wishes to alternate. The traders who succeed are those who can study their effects objectively, become aware of their weaknesses brutally, sincerely, and systematically paintings to accurate them. The buyers who fail are the ones who maintain making the identical errors, blaming external elements, convinced that in the end luck will flip. There may not. The market isn't always random. It rewards ability and punishes errors continuously over time. Another essential thing of growing timing talents is specialization. Most investors try to trade the entirety: stocks, futures, foreign exchange, crypto, all at once. They soar from approach to strategy, time body to time body, marketplace to market, by no means developing deep know-how in anything. This is a recipe for mediocrity at pleasant. The pleasant investors I've recognized specialized ruthlessly. They picked one market, one method, one time frame, and that they became absolute professionals in it. They could experience subtle shifts of their selected marketplace that others couldn't see. They knew how their market behaved in distinctive situations due to the fact they'd watched it obsessively for years. This deep specialization gave them a timing area that generalists should by no means suit. Think approximately it logically. If you are trying to song 20 stocks across 3 time frames, the usage of 4 exclusive strategies, how will you possibly develop the deep pattern recognition essential for first-rate timing? You're unfold too thin? You're constantly context switching. You by no means expand that intimate feel for the way your market movements. But in case you cognizance on 3, shares which you watch every unmarried day, studying their conduct, noting how they react to news and marketplace situations, gazing the styles that repeat, you may develop in part in the one's 3 stocks that's real and sustainable. You'll start to experience whilst something is off, whilst the rhythm has changed, whilst an opportunity is forming. This is the type of facet that matters, and you may best broaden it through centered specialized remark over time. This precept of specialization applies to time frames as well. Day trading calls for completely one-of-a-kind talents and psychology than swing buying and selling, which is completely distinct from roll buying and selling. The styles are distinct. The danger management is different. The mental demands are extraordinary. Trying to do all 3 concurrently is like looking to be a professional sprinter, marathoner, and powerlifter at the identical time. Pick one, grasp it, then in case you need to expand, you can add once more body or approach. But trying to do the whole lot right away is why most traders never acquire consistency in something. Let's communicate approximately the function of technology and timing, because this is where a lot of cutting-edge investors get seduced by using false promises. They think that if they can just discover the proper indicator, the right algorithm, the right automatic machine, they won't have to expand these talents themselves. The device will do it for them. This is a delusion. I'm now not announcing ERA is useless. Far from it. Good charting software, dependable data feeds, fast execution, these are all treasured equipment. But they may be simply equipment. They don't update judgment. They don't replace experience. They don't update the potential to read context and make split, second timing decisions based on incomplete records. The hassle with algorithmic approaches to timing is that markets aren't basically mechanical systems. They're made of human beings making selections based totally on incomplete information, worry, greed, hope, and desperation. These psychological forces create patterns, yes, however they are now not perfectly everyday styles that may be captured by using easy policies. The patterns evolve. They work until they do not. What labored in a single market regime fails in some other. And set of rules cannot experience those shifts the way a skilled trader can. An algorithm cannot feel that something is off, that the market person is changed in a diffused way. That hasn't quite proven up in the data, but this is why absolutely automatic trading systems tend to work for some time and then stop operating. Why the holy grail of set it and forget it algorithmic income remains elusive for maximum buyers. What generation can do is increase your choice making. It lets you test for setups that meet your criteria. It permits you to lower back test thoughts to see if they have statistical benefit. It can help you execute trades quickly and reliably. But the core timing decisions, while to enter, how a whole lot length to apply, while to upload, whilst to exit, these require human judgment knowledgeable via enjoy. The purpose isn't always to do away with your involvement through automation. The goal is to develop your abilities to the point where your timing selections are always worthwhile. Then use generation to execute the one's decisions efficaciously. Here's a timing idea that no person teaches. The significance of timing your buying and selling hobby to your personal, intellectual, and bodily nation. You're no longer a system. Your choice-making ability varies in the course of the day during the week based on how rested you are, how harassed you are, how clean your mind is. If you're exhausted, distracted, emotional, or sick, your timing will suffer. You'll omit alerts you'd typically capture. You'll take trades you'd usually skip on. You'll go out at the incorrect times due to the fact you are no longer wondering sincerely. Professional buyers apprehend this. They know whilst they are at their first rate and that they pay attention to their trading interest at some stage in the one's instances. They know whilst they're off and that they step apart entirely in place of forcing trades with compromised judgment. I learned this, less in the difficult manner, taking stupid losses overdue in the day after I changed into exhausted or forcing trades when I become emotionally upset approximately something unrelated to the market. Now I even have regulations about after I alternate and once I do not. If I'm not well rested, I do not trade. If I'm emotionally agitated, I don't change. If I'm distracted through private subjects, I don't alternate. It's not well worth it. The market might be there day after today. Missing in the future of opportunities is nothing compared to the damage you may do in your account with the aid of buying and selling with compromised judgment. This is every other form of timing.